Welcome back to Fresh Economic Thinking with Cameron Murray. Special guest today, Mike Fellman, old friend of the podcast. Mike heard me talking in the last episode with Moses Sternstein about his concerns about the debt burden, the interest rate on debt. And Mike jumped in and said, Cam, you're sounding like you're talking modern monetary theory, the way you're describing it. We should talk about that. So here we are to talk about it. Mike, welcome back to the podcast.
Great to be back.
So, last episode, I was talking to Moses. He had a concern that the rising interest rates meant the interest on public debt was a burden. I said, yeah, but aren't we just paying bondholders? And they're people too, and it's their income. What what got you interested in that conversation, and what led you to think, oh, that sounds like modern monetary theory? Maybe you can explain what that is uh, as
Well,
we
I
go.
think I think first we want to I should give my take on MMT or how I understand it.
Great. Which is modern
And
monetary theory, which is a
modern
sort of
modern monetary theory. Uh,
controversial um, part of economics, right? Like a
yeah,
subset of
with
the discipline.
yeah, so it's a heterodox school, but I actually think that and this is going to offend both MMT people and mainstream people, that I actually think it fits kind of neatly into standard macro if you set kind of model parameters, which is a fancy term, to certain places, at certain values, I should say, then you kind of get MMT. And so really MMT is kind of a special case of standard macro.
Okay,
And
so
so
what's standard macro say um, that about inflation and interest rates and
and
debts?
interest rates and debt is kind of so the really what standard macro is saying is that first of all, you have some constraint on government borrowing, and the typical constraint is that the value of future surpluses have to be higher than the value of bonds plus interest, or sometimes macroeconomists who can subtract interest from both sides of the equation and say that primary surpluses, that's the surplus not counting any interest expense, has to be higher than the value of the bonds. And so basically it's saying it implies that the government eventually is paying off its debts,
Yeah,
or at least generating surplus. Any debt incurred implies a future surplus. And the reason that standard macro likes this is that it precludes what some of those Ponzi games. So if you could theoretically have debt that you could roll over forever, that's
yeah,
like kind of free value, like you're borrowing without ever paying it back. So who would ever lend to you? I bet you need an infinite nut. You need a Ponzi scheme. A Ponzi scheme collapses because you run out of people willing to invest in the scheme. And
hmm,
so a perpetual Ponzi scheme implies an infinite number of potential investors. And so that's obviously can't happen. And so standard macro precludes this with this constraint that says it's called the intertemporal government budget constraint that says, that your future surpluses have to exceed your debt payments and your interest and principal.
uh-huh.
And one of the
So
things
so just
that
quickly, is this why people care about this debt to GDP ratio? Because it
that's
signals
a
for them
that
like,
so that's a
how are we ever going to pay off this debt when it's
so
twice
that's
as
a
big as
great
GDP? We're going to
That's
have to spend
a
years
great
paying
point,
off.
because technically, even when you go to when you start talking about debt to GDP ratios, you're already relaxing the constraint of
Oh,
future surpluses are greater than your debt, right? Because if debt to GDP is constant at some, whatever, I'm 100%, 50%,
mm,
200%, wherever you set a constant debt to GDP or stable debt to GDP ratio, that implies that you have some debt that you're rolling over forever, right?
yeah.
And so, uh, you're going to have an infinite number. At some point, people are going to have to infinitely be willing to. You're going to have investors willing to infinitely refinance you,
But
and it's
isn't
kind
that,
of a Ponzi.
yeah, but okay, so let's talk about that assumption. Like, I mean,
So even
isn't
the
that going to be
point I'm trying,
true though? Like the
yeah,
government.
but the point I'm trying to make more is that even standard macro itself
Uh-huh.
is willing to, or mainstream economists are willing to relax the hardcore, what's sometimes known as the strong, sound finance constraint that says that, well, future surpluses have to be exceed debt payments. They're saying, no, 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 actually, we're fine with just a stable debt to GDP ratio. You could say a stable debt to GDP ratio. You could say a debt to GDP ratio that converges to some finite value, meaning it doesn't just go to infinity. So
All
even
right.
standard macro itself is willing to is willing to say, okay, wait a minute, like maybe this idea that uh, future surpluses have to always exceed future debt payments at all times. That's actually not true. That we're fine with just a stable debt to GDP ratio, which relaxes
Right.
like kind of a core constraint, what's thought to be a core binding constraint on government borrowing.
Right. So can I just I want to try and simplify for our listeners here. What you're sort of
Sure.
saying is that standard macro has this constraint that says it's almost like saying debts must be temporary. Like you can't just have debt forever. So it's, for example, if I buy a mortgage, I have to pay it off. I can't just keep, 40% of my asset value as debt, right? I have to pay it off. I can't keep debt forever. It's only a temporary thing that I use to buy something temporarily. But what what's interesting is that in reality for business, they choose their level of debt, right? Their balance
Yes.
sheet is a choice, right? How much debt do I want to leverage my equity? So you have companies like Australia's biggest company, BHP, that's been around for 150 years. It's still got debt and it's still holding that debt balance forever. And no one ever expects it to have a zero debt balance and pay it off. So I
Yeah.
find it really interesting that when we go, oh, BHP is always going to have some debt, it needs some debt, it's leveraging its equity and it's growing. Why would you ever pay it off? That's silly, right? That just removes the leverage investors get by having debt on the balance
Yep.
sheet. And yet, for governments, the standard macro view is, oh, we can never do what BHP does. We've always got to pay off our debt as quickly as possible and
Yeah.
then have a zero balance, which seems really weird, right?
Exactly. And I think that so I think that's right as well. And also just you think of bank, every industrialized country has a debt-backed monetary system. So except for the physical cash you have in your wallet, all the money that you have is a liability of a commercial bank. And so if you say, when are the banks going to pay off all
Pay
their
off.
debts? And then
Yeah.
there's no money in the economy anymore.
Well,
Or
that's funny because people say cash is not debt, but then if you go to the central bank's balance sheet, one of its liabilities
is cash.
is cash. So people forget. People think money is an object like a stone or a rock or a shell or a piece of gold, but it's a relationship. It's and all money is a debt relationship. And your little piece of money, the way I describe it, is that the central bank has a ledger with who owes them what, but you can rip off your line of the ledger, central bank owes me, and you can trade it as a cash. So it's like a
Yes.
distributed ledger, but the
And
sum of
so
that ledger is on the balance sheet at the central bank. They owe you the money. It's not like a piece of gold or something. And it really annoys me when people say, "Oh, well, it's not real money. What about gold?" I'm like, gold is just if no one wants your gold, if no one says, "Yeah, I'll take that liability," it's not worth anything either.
Yeah,
Anyway,
and so I think a key, and you're getting into another. I think the biggest we'll get into the insights maybe of MMT,
yeah,
what I believe to be the insights of MMT later. But again, you have this budget constraint that is, that standard macro is even willing to relax, and then MMT goes a step further and says that actually there is no constraint, that the only constraint is policy outcomes. So it maps the output gap and inflation to the level of the government deficit, and says that the deficit is going to determine for any given state of the economy whatever deficit you run, which it treats as purely exogenous because there's no nominal, at least no nominal constraint on government spending.
yeah.
Um,
So
and
you used a
says,
lot of jargon then. So what's this
yeah,
output gap and what's
So it's like
surplus.
if the economy is running below potential, so if you had lots of unemployment, you have many you could have a much larger economy if you have
Uh-huh.
lots of unemployed people, and if you expect in like an economy like that to have a large output gap, meaning that not all the not all the factors of production, including labor, are being employed. And so you should have a smaller economy than you could potentially have if
Yep.
everyone was working.
Yeah. So in that situation, you're saying there's a difference. Like, so if the government spends more than it taxes when there's heaps of unemployed people, you can actually employ people, grow the economy without just getting inflation. But
Yeah.
if everyone's employed and you try and spend all that money at once, well, you can't grow the economy because it's just, there's nothing else to grow. Everyone's maxed out, and so the only thing to do with that money is bid up the prices of goods. Is that
Yes,
that's
exactly.
the
And
pretty standard view as well,
that's
right?
pretty standard view. Exactly. That's a pretty standard view. And so MMT, all it says is that it says forget there because the government can always print money, it's
Yep.
never at risk. There's no nominal budget constraint. There might be, meaning in nominal terms at least. So not adjusting for inflation, the government has no constraint on how much money it can spend. And so the only thing it needs to care about is it overspending and creating inflation, or is it underspending and creating a large output gap
Yep.
and keeping people unemployed? And so that's all MMT, or a huge thing. Not all MMT does, because we'll get to some of the other stuff later. But
Yep.
in my view, um, one of the key things that MMT is doing is it's relaxing the budget constraint further, and it's saying it's actually not a constraint at all. So we don't have like this sound constraint where future surpluses are more than bonds. We don't care about debt to GDP ratios, which is kind of like the modern view that a lot of standard macro. And we actually don't, what we care about is only
Yep.
the macro outcomes of, is inflation stable and is unemployment low, or is the output gap low, however you measure it.
Yep.
And it says you should just spend whatever, you should create whatever deficit you need in order to keep inflation low and keep the output gap, keep unemployment low at the same time. And if you overspend, you're going to get too much inflation. And if you underspend, the deficit's too low, you're going to get a lot of unemployment and slow growth.
I mean, that it doesn't sound that odd to me because, the biggest lesson in economics that you get is that economics cares about real output and real resources, as in physical resources for the
Yes.
businesses and what we can and can't do. Money is just a tool, it's just a made up thing we use to coordinate these things. And
Yeah.
I'm like, yeah, that's right. So why is money a constraint again? Because you've just spent 3 years at university telling me economics is about real resources, and then you've changed and said no, it's about these special numbers in written on pieces of paper that we owe each other. I'm like, but they're not constraints. We can write more numbers. While the real
Exactly.
these are the real constraints. And I remember there's
So,
a great
so
John Maynard Keynes article about how to pay for the war, and he says, well, you pay for it with money. You just print the money. The question is, how do you reorganize your resources to produce the wartime goods while producing the consumer goods as well without just creating inflation? So he was
yeah,
basically stating MMT, right?
yeah, that sounds about right. And
Mm.
I think another point which you got to, which I think maybe this is a decent segue, is that in a lot of ways you can think of money as tradable central bank debt. Um,
Yep.
and really in the modern financial system, which is why there's like a lot of MMT people are like finance adjacent or have worked in finance, is that government debt itself, from Treasury debt, not central bank debt, but economically, there's really no distinction between the Treasury and the central bank,
So
right? In
can you
terms,
just say so central bank debt is cash bills, right?
yeah.
And
Although some central
tre
banks do issue securities.
uh-huh. And then treasury
Um,
debt is bonds that pay you interest.
y yep, yep, exactly.
And these can be
And
substituted anytime with each other.
they can be, and they can be substituted for each other. I mean, there's really nothing. I mean, right now, I believe the Bank of Australia pays interest on reserve balances. Like if a bank deposits at the bank at the Reserve Bank, they
Correct.
earn
Yep.
interest on it. So and it's same thing with the Fed, and most central banks operate that way. Although ironically, the Fed didn't until I think around until 2008. Um,
And so just to be
but
clear, these central bank things are essentially a special different currency that the central bank controls and that
yep,
retail banks use at the central bank. So
yeah,
your bank, so the Commonwealth Bank, the Westpac, those banks have an account with the central bank, which has a different money, central bank money. And when you pay from your bank to another bank, right? They don't just go subtract one plus one. They actually go to their central bank account and say, hey, central bank, give some of my central bank money from my account to the other bank because my people
exactly,
want to take my account to their account. And so you take the liability of the bank, which is your deposit, right? Because the bank owes you that money. And, the other bank's just not going to take a liability, right? They want an asset with that as well. And so they get the customer's liability plus the other bank's asset at the central bank with this special central
exactly.
bank money. So
And so
it's like,
the point
yeah.
is,
Anyway,
you couldn't you could that system would work. You wouldn't if you just use Treasury debt as the asset instead of central bank reserves. It wouldn't change anything.
right. And in fact, before
Um,
central banking, banks would use gold and other types of high value, they would negotiate how they settled between banks, what assets they
yeah.
would accept.
And so
Yeah.
really economically, there's no real distinction between um, central bank liabilities and public debt because both I mean, like obviously public debt is going to be it could be a 10-year bond is going to have duration risk and other features with it, but fundamentally they're very substitutable. So
So
short-term government.
what I mean, are you saying treasury bonds are just like cash? And so people are saying, oh, yeah, I need cold hard cash, not these silly treasury bond things. And what you're saying is they're basically the same thing. One's a liability of the central bank and one's a liability of the treasury.
Exactly. And those are
Ah,
both entities within the government. And
wow.
so, I mean, so economically, the distinction between them is the treasury bond is going to carry interest rate risk. So it pays you some fixed rate of interest. So if you're an investor who wants to lock in, if the kind of government asset you want to hold, that's going to be the government's liability and your asset, you want it to pay a fixed rate of interest for some period of time, you'd buy a bond. And
Yep.
if you want to have a floating rate of interest where it's going to adjust depending how the Fed or the Reserve Bank puts up or down interest rates, you can hold cash.
Yeah.
Or hold, and then you're going to earn the prevailing rate of interest in the short-term market. And so there's really, but
Well,
really, I mean,
to be
these are
clear,
just
you're
different.
not going to earn interest on the cash bill that's in your hand, but when you put it in the
No,
bank, that bank will
bank,
get it in their account at the central bank, and that account will
and
pay
then they'll
interest.
pass on,
You'll
90% of it to you or
you'll get it.
whatever it is. There's some margin that they
Yeah. And so
that
so you've talked about interest, and one of the things that Moses was concerned about in my last conversation, and that you contacted me, is he said, "Well, interest is a burden, and isn't the interest burden on debt going to be a big problem?" Now, how does MMT and your understanding of interest on treasury bonds, which are government debts,
well,
what does it mean economically in the
so
MMT lens?
MMT is mapping, you have to think back. MMT is just mapping the government's deficit onto inflation and the output gap. So it's saying for any, again, so if the economy takes some huge shock, like COVID or probably the great, I think the better example is the Great Recession. Um,
2008
there
9
was
period.
2008 and 9. Like we had, the United States had deficits, 8, 9, 10% of GDP, and there's no inflation. And it's because the economy was so crippled, so there was so much unemployment, there was such a huge output gap that even this massive amount of fiscal stimulus wasn't able to bring the economy back like, up to its capacity and then hitting its capacity and having that money just bid up prices. That no, even though this humongous fiscal stimulus didn't
So
create
what
any
you're saying is
inflation,
8% deficit gap is the government is spending 8% of GDP more than it returns than it gets back in taxes.
Yep.
So if GDP is a trillion, um, the government's spending $800 billion, not just
Or
spending
80 billion.
80, sorry, not just spending 80 billion, but spending 80 billion more than what it's taxing. So it might tax 800 and
Yes.
spend 880. Um, wow, okay. And that didn't cause
And
inflation.
so
And was anyone
it
worried
didn't
then
cause
about
any.
the interest on debt and
Absolutely. People were very worried. Like there was lots of people. Kevin Warsh himself, who's now Fed chair, was very worried. I mean, I think this is kind of disqualifying in my view to even to be Fed chair, but is that he was like really worried that we're going to see tons of inflation from quantitative easing in 2009 and all this government spending in 2010. He didn't realize that quantitative easing is not inflationary per se, because all you're doing is you're replacing one form of government debt for another. You're replacing bonds for central bank reserves. So now all it's saying is instead you were some investor and you had some instrument that was paying you, fixed rate of interest, let's say 4% per year, and now you have cash and you're going to earn, or you have central bank reserves and you're going to earn a floating rate of it. You're going to earn whatever the prevailing rate is in the short-term money
Mhm,
markets. That's all it is. It's just an asset swap. And
mhm.
so it shouldn't be inflationary. You're not adding any new money to the system. You're not adding any new assets to the system. And the deficit, so what MMT would say is that the deficit itself is inflationary, but it's only inflationary if you push GDP above potential to where you're only bidding up prices. And that seems to me very standard macro-ish. And so I don't know why people are, I think, up in arms about
And
MMT is so out of left field and is so kooky or whatever, because
would you say that's what happened during COVID then, when a lot of governments, they not only reduced the ability of the economy to produce stuff by closing borders and locking down and stuff, but then they also put a lot of spending into
they
the
put a ton of
economy?
cash into this. They put a ton of money and spending power into the system but you have to realize that when COVID happened, they spent, for 2 years, I think the deficit in the Great Recession in 2009 was like 9% or 8% of GDP. And then it steadily fell, in 2010, 2011, and by the time, Obama left office, the deficit was maybe 4% of GDP, which is a little bit elevated, but for a peacetime deficit historically, but it's pretty normal, right?
Hmm.
And with COVID, for 2 years, deficits were 15% of GDP, so significantly higher,
Wow.
um,
So
and
twice as
then
high
during the
as the
twice
Great
as high
Recession, it
recession, and
seems.
for 2 years,
Wow.
and we're phased out rapidly, but even so, we're still to this day at about 6% of GDP deficit, almost 7%. And so yeah, it's no kidding that we can't get the last one. It's very difficult to get the last 100 basis points or so out of inflation out of the system. When I say 100 basis points, I mean that inflation is between 3% and 3.5%, and it's supposed to be at 2% according to the Fed.
Yeah.
And it's very difficult to get that out of the system when you're running 6-7% GDP deficits in a full employment economy. It's kind of surprising inflation's not higher, to be honest.
Yeah.
Um, uh,
Yeah. So you're saying there's just still heaps of fiscal stimulus is what the standard would
yeah.
say
Now,
floating around.
what I think we can connect back to
Mm.
kind of what Moses was saying about interest rate burden. I
Yeah.
think there is a big distinction between primary spending, which is spending that the government is actually paying to use real resources or
So
consume real resources,
so when the government
and interest
pays
spending.
people to get, medical treatments, or pays people to build roads, or pays people to, build
Yeah,
jet fighters for the military, they're taking people from what they're doing and devoting those resources to making stuff for the government, right? That's what you mean by
right.
real spending.
And exactly.
Yep.
and got interest spending, which has become a bigger and bigger part of the deficit. I think that's a lot less inflationary because those investors, if someone buys a treasury bond, their revealed preferences is to save and not spend, correct?
Right. So you're saying the interest on these treasury bonds is paid to people who own treasury bonds. And those
Who's
people own treasury bonds because they don't want to buy goods and services.
Exactly. And so
Okay.
there, if you think about, Keynes is marginal propensity consume, like their marginal propensity consume is already really low. So they might be getting the interest payments, but they're probably reinvesting them. They're rolling them into, more treasury bonds or other, super safe assets and kind of just sitting on it. And so I view interest, I think one explanation for maybe why the inflation is actually not higher is because so much of the deficit, over $1 trillion of the deficit in the United States is coming just from interest payments. It's now the third largest item in the budget, which is freaking a lot of people out.
Hmm.
But I think it's not terribly inflationary because it's going to people who have a low marginal propensity to consume, or not even institution, like foreign central banks and all kinds of
Yeah.
uh, actors who are not going to go out and try to buy goods and services with these interest payments.
Yeah. So how do we think about that as a burden then? So I mean, we're still kind of printing, we're still kind of printing money or taxing people to put money in the accounts of people who own treasury bonds in the form of interest. And is there some kind of cost to that in the economy? Like, I'd be a bit annoyed if I'm an American and I'm paying taxes, and a big chunk of my taxes is actually crediting, some foreign central bank for the interest on their holdings of treasury bonds. Like, is there some kind of economic loss here from this transfer? That's the sort of question I
Um,
think Moses got to. What's your
I think
take?
so. I think the
Hmm.
way to think about it is that I think that a lot of ways is the U.S. is able to earn a lot of well, first of all, like so we talk about cash, like there's two-thirds of U.S. currency is held overseas. And so that alone is a humongous freebie for the United States because we don't just give the money away so that other people in foreign countries can hold physical US dollars. Like they earn those dollars from us. They buy, they have to sell us goods and services and the money ends up abroad, right? In physical cash. And that's not paying them any interest at all. And so we got something in exchange for that physical cash. It circulates abroad and theoretically, until they don't get to redeem, in quotation marks, that liability until they buy something from us. And are we going to be like unhappy when if foreigners start buying more things from the United States? I mean, that's something that every politician is trying to promote, right? They're like, no, we want to export more and we want to. And so I think a lot about um,
So
there's a
you're
tremendous
saying, just to be clear, all these foreign banks that now earn this US dollars, well, they can exchange them with other foreigners who want US dollars to buy, Ford Rangers from America, or,
right.
Facebook's, ads, or Apple products, or whatever the case may be, right?
Exactly. And so we're
And
not going to
that's a
be
good
upset.
thing.
That's a good thing. Like we're not going to be upset that, if and when uh these, the foreign sector, which and on net desires to save in terms of US dollars. They want to be, if you just think of the everything outside the United States or outside of Australia, or whatever country you're in, is the rest of the world is the foreign sector. And if you're running a current account deficit with or trade deficit with the rest of the world, all that's saying is the rest of the world desires to net save in terms of your currency.
Yeah, so
And,
so what you're saying is if you import more than you export, how do you pay for those imports? Well, you sell a treasury bond, and then
yes.
they, that's sort of how you pay for it.
And so at some point, like, yeah, the rest of the world may no longer desire to net save in US dollars. And what they're gonna what how would they stop, how would they start dis-saving US dollars? We're buying lots of things from the largest acceptor of US dollars, which is the US companies and
Yeah.
the United States itself. And I don't think we're going to be upset, as you said. I don't think that it's going to crash the economy if like the Chinese start buying more Ford Rangers. I think it might grow the economy in the United States.
Right. So it sounds like the MMT focus is all about what's happening in the real economy. All these balances balance for certain reasons. Interest, is just a transfer to people who want to hold US dollar savings. It's not like going to cause inflation. I still don't know if there's a huge cost to that, but I mean, a lot of this sounds still pretty standard to me.
Yeah.
So,
And so I
so
think the biggest thing gets back to the relaxing the relaxing the budget constraint to the point where you say that it's not a constraint. It's only the budget deficit is merely a macroeconomic tool, no different from where the central bank sets interest rate. We don't, the any central bank, people talk about the zero lower bound, although we have seen negative interest rates, can set the interest rate wherever it wants, and nobody thinks of just like, oh, we can't set it at this level because terrible things would happen. I mean, it's going to create winners and losers in the economy, of course. And so all they're saying is that the interest rate where the bank itself is viewed as a tool that is used to target macro outcomes. We assign it to inflation. But you can think of the budget deficit itself as nothing more merely than a tool because there's no actual solvency constraint on the government, and so the only thing we should be worried about is inflation and unemployment. And
yeah, so
MMT
we
is very
call that sort of
skeptical of you.
fiscal dominance. People say, like, yeah,
Yeah.
interest rates can change output a little, but you know what works really well? Having a huge deficit when everyone's unemployed and spending
Yes.
money on stuff. Um, so does that imply then that if we can't get inflation down, that MMT would say, hey, government, stop trying to buy things with this
Yes,
deficit and
exactly. And
tax
then
us more?
the MMT people have said that. I think the problem with MMT is that, politically that's incredibly hard to do. I mean, so someone asked me, uh, my opinion. This is back in like 2022 when inflation was really taking off, and they said, someone involved in politics and said, well, what can we do within an electoral time,
Mm.
that's like, in a timeline that's electorally relevant, meaning before the next election, to get inflation down? I say, hey, middle class tax increases. And they didn't like to hear that, but that would have gotten inflation well under control much faster if you just take spending power away from consumers who are bidding up all these prices. Uh, and it was very difficult because I think that one of the big successes of the pandemic response is that everybody believed that, we're going to have a second Great Depression because of this, because there's going to be so many business failures and everyone's going to go out of business. And, with this massive wall of money that was pushed onto the economy, that didn't happen.
Yeah.
And um, but phasing that out, first they overshot, and then phasing it out was very unpopular. And people got used to, government checks and expanded unemployment benefits and all these things. And
Yeah.
phasing it out was tough, although it was phased out, but it should have been phased out faster.
So,
Um,
so how do MMTers think about this relationship between the budget deficit, like government spending more than they tax out and increasing the amount of money circulating and buying power, and the sort of central bank mandate and how their actions will offset that? So, the standard view is in Australia, for example, the federal government's spending lots of money right now, and people are saying, well, that's why interest rates are high because you keep pushing up inflation. And the response of the central bank is to put interest rates up. If the government could be more disciplined, and interest rates would come back down. Is that a true statement and what MMT would also say?
so, so I think that there you just have you're mapping. So I would say that MMT's theory of the term structure of interest rates, which is a fancy term. So that's just saying the relationship between how long a bond takes to mature and the interest that it pays,
Mm-hmm.
right? So is just the expectations theory of the term structure, which just says that if a 10-year bond is yielding 6%, then the expectation is that the average interest rate in the short-term market over those 10 years is going to be about 6%. So you're actually no better off holding cash versus holding the long-term bond,
Mm-hmm.
in equilibrium, right? It's the market
Mm-hmm.
expectation. Now, obviously, it might not work out that way because things can change, but the market if it's priced efficiently
Yeah.
over the long run, you should never, there should be no you shouldn't be able to systematically earn more interest holding longer term bonds versus cash.
Yeah. So how does
And
that matter for the
so
cash rate that we use to
and
try and
so
manage the economy?
so it matters so what the long term bonds what MMT would say is, and this is a very standard view as well, is it just says any the yields on long term bonds just reflect market expectations of where short term cash rates are going to be over the life of the bond.
Ah, okay.
That's it. And so if you're saying that the government's overspending, that's pushing up inflation, that's causing the central bank to push interest rates up, well, then you're mapping government deficit, that's mapped through the central bank's reaction function. So that at that point you have one part of the government actually fighting with the other part. Because
Correct.
if the federal government is running a big deficit, it's saying we want inflation to be higher,
Yeah.
right? That's what they're saying. Now they might be doing it intentionally, but that's the actions they're taking are saying
Yeah.
that, we want inflation to be higher. Whether policymakers understand that or not is a different separate issue. And the central bank is saying, no, we want inflation to be lower, so we're going to put interest rates up.
Yeah.
Um,
And
and
so
so it's
how does higher interest rates cause inflation? Because or stop inflation? Because we've just said, well, the government gives people more money to spend, and when we all try and spend lots more when the economy is at full employment, and we can't really build more houses because every tradie is fully employed, then we make bid up prices. So how does the interest rate stop us bidding up prices?
so the MMT view is that it doesn't, and the
Oh,
MMT view is that it's actually inflationary, and I'm going to explain that in a second.
okay.
Uh, but the standard view is that when you raise interest rates, you just you're slowing down the economy. And so
Why?
if you have the economy, well, because the incentive to invest, uh, if you think of GDP, if you just think of the GDP formula as or GDP is equal to consumption plus government spending plus investment, minus plus net exports. Um, then if you increase interest rates, the
People don't want to invest in building new
vest
factories and stuff because
and
they
that's
can
going to
get
lower that's going to
6% in
lower
the
GD
bank.
that's going to lower nominal GDP, and that's going to bring nominal GDP
Yeah.
back below, so it's not over potential anymore. It's no longer causing inflation because the investment is going to be a function of where interest rates are. The higher interest rates are, there's less incentive to invest because the rates of return on your project are going to be less likely to clear
Yeah.
hurdle rates, which are going to
So, for
be
example, I would say, if I could get 10% putting my money in the bank because the government put interest rates up, I'm not going to go and buy new houses off the plan that, give me a 3% yield and
rental
hope that I
yield.
make it up.
Exactly.
Hope that I make it up. So I'm going to stop investing. And my business, if I can get 10% in the bank, I'll be like, gee, I'm not going to really expand. I'm going to have to make, there's a lot of risk in that. I might need 20% um,
Exactly.
return, and that next expansion is not going to make me 20% if I build a new factory here or warehouse. But if
Right.
the interest rate in the bank is 2%, I'll be like, oh well, I can expand and build that factory on a 12% return and
Right.
cover my
And if
risk.
that factory is not getting built, I mean, it's less cement, it's less steel, you're
Correct.
employing
Yeah,
less
yeah.
people to build it, and so you have less pressure in the economy, you have less nominal spending in the economy, and it's gonna
Now, I think that
relieve
works,
pressure on
right? Like in
prices.
Australia, that really works because people stop buying new houses and they stop spending on construction, right? And construction's a big part
Yep.
of the investment in the economy. I think that that works. I think it really does because we see when we drop interest rates, everyone decides they need to buy houses and build new apartment buildings and whatever.
Yeah.
Why does MMT say it doesn't work?
So they say it's all on they say it's all on the fiscal side. They say that fiscal is what really matters. So that they say, either adding purchasing power directly through fiscal stimulus or taking it away through higher taxes is what really matter is what is much more powerful for targeting inflation, which I think that that story makes sense to me. If like rather than saying I'm going to put interest rates up and hope that people invest a little bit less and hope that that brings down inflation, to say no, we're just going to take money, we're just going to tax you more so you have less
Yeah.
purchasing power. So you're spending less no matter what.
Okay. So
Um,
we
so
agree currently that MMT that probably there's what we'd call fiscal dominance, that it's much easier to reduce inflation by taxing
yeah,
people more than
and
you
and the
spend.
MMT also says, although I think there's a little bit contradictory, because in a sense, is they say actually when you raise interest rates, you're actually increasing the deficit and payments to bondholders, and so that actually when you raise interest rates, you're increasing government spending on debt service, and that itself, that's more government spending, and that can be inflationary. And I think Warren Moser calls this the interest income channel. I don't buy that as much because, again, I just think that the revealed preferences of most bondholders is to save and not spend.
Yeah.
Because
So
if you
we
wanted
just
to,
discussed that before. Like we're paying interest to people who don't want to spend money, and
yeah,
that's going to encourage them to spend even less, right? Because they're now like, oh, I should buy more government bonds rather than building a factory, right? Because the
right.
price of saving is different, even though the flows of payments might be more to them. That's because, they're getting a higher price. They're getting more of a return.
Exactly. So I'm a little skeptical. I'm very skeptical of the interest income channel. In theory, if everybody owned government debt and
In equal proportion.
equal proportions and interest, if you had a massive debt load, where
Yeah.
if you think of the marginal propensity to consume of investors in government debt as being very low, but interest rates were 1,000%.
Yeah,
Well, then,
yeah,
yeah,
yeah, yeah.
like these interest payments are going to be inflationary because, their marginal propensity to consume is not zero, so they're actually going to spend some of the money that they're getting from these bonds. But if interest rates are low or not astronomically high, or at some reasonable level, I don't see that,
So do you think
getting your
MMT
6%
then?
coupon is going to cause much inflation.
So I'm thinking about Japan now, right? Because Japan has a large government debt and its
Yes.
interest rates are rising, but its economy is growing and it's finally got inflation after 20 years. Is there an MMT story here that, oh, interest rates have gone up in Japan to prevent inflation? Now that's paying more to bondholders. Now these bondholders, maybe it's widely held. Maybe everyone has like 10 bonds each in Japan. I don't know. And now they're getting more interest, so they're spending more, so they're getting more inflation, so they have to put the interest rate up. So are you sort of saying that the standard MMT view is there's some kind of like high interest hyperinflation trap, like a monetary policy inflation trap, where you put interest rates up to stop inflation, you pay everyone and you get more inflation, so you put interest rates up more.
Yeah.
Like, is that
So
kind of the logical implication of their view on
yeah, I
high
think I
interest
think
and
that's
inflation?
that's right, I think it has to do with the marginal propensity to consume of the average bondholder, and it has to do with how big the debt load is. And
Yeah,
so I think theoretically you could write a model down that says, okay, interest rates are 100% and the debt load is huge and is very widely held in the economy. So you're increasing the spending power of every household
yeah.
substantially when you increase interest rates. And
You're almost saying it's equivalent to a deficit then, right? You're just giving people
yeah,
more
I
money
mean,
than you're
but I
taking
just don't
back.
think the real world. I think that that's just kind of a toy model, and I don't really
Yeah,
don't. The real world, it's not like that. Bonds are not widely held by households. I think households, in the United States, there's over 30, there's like 30 trillion, or, the 38 trillion in debt
Yeah.
gross. And I think US households own less than 200 billion
No
of
way.
that.
So that's less
And
than a
so,
third of a percent. Oh no, sorry,
yeah, it's
3%.
like,
They own 100, but yeah, a couple of percent out of the whole balance is owned by
so
households.
like, and again, and these are the households that do own it are, have a very low marginal propensity to
So
consume.
yeah, so they're
Uh,
already rich, so
you
they're
know,
not changing how many cars and
I
they
had,
buy or
yeah,
shopping or
I mean,
holidays.
I had a friend who, obviously a retired gentleman, who I knew who owned some treasury bonds, and I can guarantee you that he was not adjusting up his budget because his treasury bonds were,
Yeah.
paying him a little bit more in interest when interest rates rose. Uh,
Yeah. So so is there anything else on MMT we've missed so far? Because I feel like we've had a pretty good tour of it. And I think we disagree. We both disagree with the MMT view that higher interest rates are inflationary. I think I don't really see a pattern in the data that would
yeah,
show that.
I think I would say that you can write down a model that says under certain conditions, which we've laid out, which is like widely held public debt level, it's very high public debt level, where raising interest rates and the federal the government itself doesn't react to higher debt payments by trying to reduce by cut non-interest spending. So if every time interest rates rise, it just mechanically increases the deficit, and
Yeah.
these interest payments are going out to all most households. Like, yes, I would say under those conditions, higher interest rates are probably inflationary, but I don't see those conditions really ever prevailing in any sort of economy. Although, ironically, in Japan, there's kind of maybe in Japan because like there's this whole joke of it's like about Mrs. Watanabe, which is supposed to be like the personification of the Japanese retail investor.
Yeah.
Um, and so I don't know, maybe there's a lot of I don't know how how
So
much Japanese households own in government debt in Japan, but
I'm
um,
just yeah, I'm just wondering the experiment here. So how does MMT say you deal with inflation? Like, what about Argentina and all that? Like, so would they disagree with Millei's cut the budget type thing for
no,
inflation? Or
they would agree with it. They would say that's
uh,
exactly what you do.
so he cuts the budget, but he's got to keep taxing. He can't just give it all back in taxes, right?
Right, yeah, you have to reduce the spending power of that's out there in the economy. So
So
you
that
can't just
sounds
if
like
you
it's like such a like right wing thing politically, that if there's inflation, we got to be strict. We got to cut the budget. Um, that's like pretty standard
cut the
right
budget,
wing
but as you said before, not cut taxes
cut
at the same
taxes.
time.
Yeah, right, right.
So
Um,
start, reduce the budget deficit, do actual austerity.
so tax more than you spend. Do actual austerity. Yeah, okay.
Yeah.
That's really interesting. Um, that that's the case because I think in the public conversation, MMT is associated with the left wing because
Yes.
what you'll see politically is so we've just talked about actual economics and the function of the monetary system. Most people don't know anything about that. They operate at a different level, which is like he said, she said politics. And so what I find interesting is left wing people will say, oh, the government says it can't afford public housing. So we've got to find the money for public housing um, by raising a certain tax or fee, and they sort of I think get confused because governments are saying we don't have the money. Uh, they're saying that in words. The meaning they're trying to convey is we don't want to do that. We don't want to spend on your thing. And the left
Yes.
takes seriously that, oh, the problem is there's not enough money to do all the good things. And therefore, MMT says there's no budget constraint. Therefore, ha ha ha, MMT will solve all our left wing political problems. Um,
Exactly.
Ignoring the fact that the government, is going to put $200 billion a year on their budget to spend on submarines when they say we don't have 1 billion to spend on public housing. Like, of course they've got the money. They put 200 billion towards submarines and
Hey,
what, like,
as a side note of that, is that still a salient issue in politics in Australia with the whole submarine deal
the
with
AUKUS submarine deal where we're paying,
yeah.
well, yeah, people are like, you're just writing blank checks to the Americans to buy F-35s and submarines, and nothing's going to get, nothing's going to get delivered. And uh, yeah, it really is because we're getting really nothing for it. And all the timelines are blowing out. And apparently, recently, it was reported that the Americans are going to give us some refurbished old submarines instead because they want to keep all the new ones they're making. I mean, so I guess,
On
yeah.
behalf of my government, I apologize, but if you don't get a, well,
So I
no,
guess, yeah, go.
it's a great example of just, again, that's going to take, and the fact that we might be not getting the best deal as either, because what are we getting in exchange? We're getting nominal dollars, or I don't know how this is going to be financed, but we're getting some financial asset and we're devoting real resources to produce these submarines, right?
Yeah,
And F-35s, and that's nominal income for some people, but it's also removing real resources from the U.S. economy and shipping them abroad. Uh, and
yeah.
so,
So that's the thing with
so
MMT as well, right? They say imports are free, like, exporting is a cost because we've put all these
yep,
people to work building jet fighters, and then we've given them to you and we don't even keep them.
yes,
But I
that's
think
another.
that's
I think it's
yeah,
about right. I think it's right. I think that obviously I think where MMT goes a little astray here is that in exchange for sending the jet fighter to Australia, U.S.
yeah,
companies and U.S. persons are getting a financial asset that they could then use in the future to buy something from Australia or from anyone else in the world. So it's not
yeah.
like you're getting nothing in exchange.
Correct. But I think this is my problem with MMT. They're really big at looking at both sides of the ledger, right? Like, oh, your money is an asset for you, but it's a liability of the bank. The treasury bonds are an asset for you and a liability of the government. So when you say, oh, you're burdening future generations, well, you're burdening with the assets too, not just the liabilities, right?
Yeah.
They're really good at
Hmm.
looking at both sides of the ledgers. And then you'll have someone, is it Warren Mosler or one of these guys who's MMT, come out and say, oh, exports are a cost and imports are a benefit. I'm like, but you're also looking at one side of the ledger because you get paid for them and you get money back. Like,
Yeah.
you can't just look at one side of both
You get
sides
you
of the
get
ledger on one.
claims. You're getting a claim on, when you export, you in exchange you receive a claim on the purchaser of the export.
Correct. And you can
And
go and buy an
the
import with it, right? Or
and
do
then
whatever.
and
It's your
yeah, and
choice.
financing and financing is, the magic of finance is that intertemporally it allows us to intertemporally transfer consumption, because I
Correct.
might say, hey, I'm fine sending you an F-35, but in 5 years from now,
Yeah.
I want to buy something from Japan or,
Yeah.
the EU. And, so I'm happy holding this financial claim that I'm getting in exchange for selling the F-35. And I think that's a good thing that we're able to do that with finance. It shouldn't be that, in any given year, all trade balances have to equal out, because consumption, people want to intertemporally transfer their consumption.
So,
Uh,
oh, that's interesting you say that because isn't wasn't Keynes's big idea in the Second World War that a lot of the problems that lead up to conflicts are these balance issues that one country starts owing the other. They've imported more than they can export. The other country is like, oh, well, we don't think you're good for this. We don't want your currency anymore. And so he had this idea of the global central bank that would manage the exchange rates to try and keep trade
Yeah,
balances.
and that's where the IMF comes from,
Yeah,
and the
yeah.
World Bank. And
Do you think these balances are risky in the modern world? These
I mean,
trade balance differences, for example, China's trade balance is different. Do you think they're going to say, "Hey, we think these US dollars we've accumulated are bad now. We're going to crash your currency when we wage war on you by selling all our US dollars." Like, is it a
um,
risk, or do you think it's not such a big deal these days?
I think right up until now it's not such a big deal. I think that obviously uh, you cannot issue an unlimited amount of claims on yourself to buy imports, forever, and that at some point, um, you have to pay back those claims by selling more abroad than, or increasing the amount that you export relative to imports. But I think that the trade imbalances just reflect the current preferences of the consumer bases in different countries. And
Oh,
so I don't think, there's a time when the US was had a huge current account surplus and exported way more than it imported. And now, there's a time where right now the US has a trade deficit, right? And so just because, that just reflects the saving preferences of the households in your economy. And it's just going to depend on, demographics and a lot of factors.
yeah, brilliant. Mate, we might have to wrap up this grand tour. So, in conclusion, Moses is worried, and many people are, that interest on debt is a burden on our grandchildren. What's your opinion? You're sort of MMT savvy, but skeptical and very clear about the standard view. Um, what's your take? Is it a burden on our grandchildren that we must quickly solve by paying it all off, or how should we think about it?
So I think about it the same way as earlier, is that I think it creates, how it would manifest itself as a problem is if the interest payments start becoming inflationary. So if we did ever approach uh, what I called earlier as kind of a toy economic model where, the debt level is very high, debt is widely held by households, and interest rates are high so that interest payments are substantial and
Hmm.
actually injecting a lot of purchasing power into the economy that's getting spent. I think that, under those conditions, you would have something where you would have to you would paradoxically get a situation where you'd want to cut interest rates to combat inflation, but then that's also might have, that might be undesirable for other reasons, might cause asset price distortions
Mm.
or whatever. And so you're kind of when you have the concern I would have is that, and I think the reason why MMT is what they're saying, and when it's not a burden, is they're saying, well, we don't think that interest rates matter at all for managing the macro economy, and so we should only use the budget deficit or surplus.
Yeah.
And so we don't care if, if we don't have the maneuverability to put interest rates way up because the debt load is high and it's actually gonna meet the conditions where it's gonna be inflationary. They say, well, we don't care about that because we're just gonna use we're just gonna use primary spending as the tool, as the
Right,
one
right.
and only tool. And I take a more nuanced view that I think that no, it's actually nice to have this second arrow in the quiver, because I do agree that at least in the short and medium term, yeah, if you put interest rates up, you're going to slow the economy. And
Yeah, right.
uh, and so you might want to be able to do that rather than just raising or lowering or spending your taxes. You might want to have this other tool in the toolkit. But yeah, if you had, if debt to GDP was 1,000%, and the debt's really widely held, probably under those conditions, raising interest rates are going to be inflationary, and I don't want to use the term boxed in because you can still use fiscal policy to manage the economy, but you just have one tool less. So that's
Yeah.
that's where I think the actual danger is. I don't think it's going to bankrupt the country or do anything like that.
So, yeah, and I think it's interesting that even under the current monetary policy regime, like, we lower the interest rate when the economy's soft and raise it when it's booming, doesn't that automatically reduce the interest burden? If for some reason the high interest rate crashes the economy, all these interest payments are bad for the economy. Okay, well, if the economy starts contracting, then we'll lower interest rates, and then the
Interest
interest
rates,
burden will
yeah.
disappear automatically. Um, and I think you're right that there's always fiscal tools, and I do find it funny. I think it's really like a fad in economics to have this monetary policy. This is the one and only tool, and really neglect fiscal. Even though I think the Australian budget recently recognize that the government will have to tighten spending in certain areas if it really wants to get inflation back down. That last, percent that you mentioned is also a problem in the US. I think everyone's got used to the high deficits since COVID. So I think
Yes.
people recognize it, but it's not the main part of our conversation. It's just, what's the interest rate going to be? How are we going to step on the accelerator and manage the economy? Mate, Mike, I think we might have to wrap it up. I really appreciate that deep dive. There's really not many people out there who take the time to dig into macro and the different competing views and the operations of money and debt. So I appreciate your insights. Thanks very much.
My pleasure.
Thanks, man.